What is going on, Future Focus Nation? My name is George and I make videos to help you make money investing. Today, I wanted to dive back into ASE Technology Holdings, ticker symbol ASX. If you've never heard of ASE Technology Holdings, I suggest you click this link up here or go in the description below and watch that video that I made on ASX before you watch this one. On that video, I go into depth on everything that this company offers. This company is actually a combination of 3 companies, and each company does something different, all in the semiconductor space. I'm making this video today because lately I've been getting a lot of questions about, is this company still a buy? And I said, you know what, let's just make a video about it and share my research with you. So today we're going to be going some of the latest news with ASE Technology Holdings that I think is relevant, and we're going to look at the charts. With all that said, let's dive right into it. ASE Technology Holdings Company Limited. Consensus indicates potential 10.5% upside. ASE Technology Holding Company Limited, founded using ticker ASX, have now 4 analysts covering the stock. The analyst consensus points to a rating of strong buy. The target price ranges between 10.2 and 6.6, calculating the mean target price we have 8.55. With the stock price previously closed at 7.74, this indicates that there is a potential upside of 10.5%. The 50-day moving average now sits at $7.64, and the 200-day moving average is 6.34. Here's another article. Is ASE Technology Holding Company outperforming other computer and technology stocks this year? Well, let's find out. For those looking to find strong computer and technology stocks, it is prudent to search for companies in the group that are outperforming their peers. Has ASE Technology Holding been one of those stocks this year? A quick glance at the company's year-to-date performance in comparison to the rest of the computer and technology sector should help us understand this question. ASE Technology Holding is a member of our computer and technology group, which includes 623 different companies and is currently number 11 in the ZAC sector rank. The ZAC sector rank gauges the strength of our 16 individual sector groups by measuring the average ZAC's rank of the individual stocks within the group. The ZAC's rank is a successful stock picking model that emphasizes earnings estimates and estimate revisions. The system highlights a number of different stocks that could be poised to outperform the broader market over the next 1 to 3 months. ASX is currently sporting a ZAC's rank of number 2, buy. Over the past 90 days, the ZAC's consensus estimate for ASX full year has moved 33% higher. This means that analyst sentiment is stronger and that stock earnings outlook is improving. Based on the most recent data, ASX has returned 29.97 so far this year. In comparison, technology companies have returned an average of 14.75. This means that ASE Technology Company is outperforming the sector as a whole this year. Looking more specifically, ASX belongs to the electronics semiconductors industry, which includes 35 individual stocks and currently sits at 109 in the ZAC's industry rank. On average, this group has gained an average of 6.31 so far this year, meaning that ASX is performing better in terms of year-to-date returns. Going forward, investors interested in computer and technology stocks should continue to pay close attention to ASX as it looks to continue its solid performance. ASE Technology Companies announces its unaudited consolidated net revenues for March and first quarter of 2021. So these are their latest consolidated net revenues, but these are unaudited. What we do see here is that their consolidated net revenues increased 14.7% in net revenue difference, which was a sequential change from quarter to quarter, and they had a year-over-year change of 10.9%. However, in their assembly, testing, and materials business, they were down 18.4% quarter over quarter. However, they were still up 30.1% year over year. You can't blame ASE Technology Holdings for being down quarter over quarter, even if it was as much as 18%. You need to understand that the semiconductor business is hurting right now. The purpose of the assembly portion of their business is that they take certain materials from Apple, from Nvidia, and from other chip makers, and they consolidate them and turn them into different wafers, which are used for different things. Semiconductors are built different, whether you want to use one for an electric vehicle, or let's say you want to use one for a cell phone. They have to be packaged differently, and that is what their assembly portion does. If they're not receiving the parts from these companies because the companies don't have them, they have a huge shortage, then ASE Technology has nothing to assemble. But this is a great problem to have. Anytime you have a company that has more demand than they have supply, that always works in their favor, and that's always a great problem to have. Here's another article from Yahoo Finance. Here is why growth investors should buy ASE Technology Holdings now. Growth stocks are attractive to many investors as above average financial growth help these stocks easily grab the market's attention and produce exceptional returns. However, it isn't easy to find a great growth stock. In addition to volatility, these stocks carry above average risk by their very nature. Also, one could end up losing from a stock whose growth story is actually over or nearing its end. Here are three of the most important factors that make the stock of this integrated circuit maker a great growth pick right now. Earnings growth. Earnings growth is arguably the most important factor, as stocks exhibiting exceptional surging profit levels tend to attract the attention of most investors. For growth investors, double-digit earning growth is highly preferable, as it is often perceived with an indication of strong prospects. While the historical EPS growth rate for ASE Technology Holdings is 3.2%, investors should actually focus on the projected growth. The company's EPS is expected to grow 40.5% this year, crushing the industry average, which calls for EPS growth of 38.7%. The second one is cash flow growth. While cash is the lifeblood of any business, higher than average cash flow is more important and beneficial for growth-oriented companies than for more mature companies. That is because growth in cash flow enables these companies to expand their business without depending on an expensive outside fund. Right now, year-over-year cash flows growth for ASE Technology Holdings is 19.4%, which is higher than many of its peers. In fact, the rate compares to the industry average of 12.4%. While investors should actually consider the current cash flow growth, it's worth taking a look at the historical rate too. The company's annualized cash flow growth rate has been 12.2% over the past 3 to 5 years versus the industry average of 10.1%. The third consideration is promising earnings and estimate revisions. Superiority of stock in terms of metrics outlined above can be further validated by looking at the trend in earnings estimate revisions. A positive trend is, of course, favorable here. Empirical research shows that there is a strong correlation between trends in earnings, estimate revisions, and near-term stock price movements. The current year earnings estimate for ASE Technology Holdings have been revising upward. The ASX Consensus estimate for the current year has surged 5.3% over the past month. The bottom line, ASE Technology Holding has not only earned the growth score based on a number of factors, including the ones discussed above, but it also carries a Zacks rank number 2 because of the positive earnings estimate revisions. And again, Zacks ranks it number 2, which is buy. Again, one of the reasons that I like this company is that it's in a sector that has more demand than supply. Right now, the entire technology sector is hurting for semiconductors. And here you have a company that makes them themselves with proprietary technology, tests them for other companies, and also assembles semiconductors for big companies you've heard of like Apple and Qualcomm. But let's take a look at the chart. This is the one-year chart for ASE Technology Holdings. And this is something that I referenced in the last video I made, that you can see the slow and steady growth on this company. And it's not like one of these moonshots that happens to the other companies. This stock has been going up slowly and slowly. A lot of companies right now that are not doing so hot in this space have hit a double top, which means they have hit their high, they have dropped, they've hit their high again, and then they've plummeted down. However, this company hit a high of 8.71 on February 12th. It dropped again slowly, and since then, it's been having higher highs and higher lows. That is always a bullish sign. Here's the 1 month chart. Here is the 1 month chart for ASX. I would put a level of support at $7.73. If it goes beneath that, then I'd be cautious. Here you have the 1 month chart for ASX. I would place a level of resistance here at $7.97. If it closes above this line for 4 to 5 sessions, then I would make this the next level of support. And this is one of the things that I like about the company's technicals, is that it goes up slowly. It doesn't just shoot up like a lot of these other stocks. A company shooting up is not something you want to see. You want slow and steady growth, because slow and steady growth is consistent. So I gave you both sides, a little bit of the technical and a little bit of the fundamental reasons why I still think that this company is a buy. But what do you think? Is this company a buy, a hold, a sell? Are you going to avoid this like the plague? Let us know in the comments below. If you haven't joined the Discord channel yet, join us. It's free, and the link to it is in the description below. As always, invest in me and press that like button. Invest in yourself and smash that subscribe button. It costs you nothing. Until next time.